day of the banking because it's Nifty Bank that has surged to an all-time high levels. And amidst that, a very strong set of numbers coming in from Yes Bank as the net profit in Q4 has zoomed 63% on a YoY basis, while we have seen an improvement in their core lending business as well, which has boosted the NII of the bank. But what's next and what is the outlook going forward? Let's take this discussion with Mr. Prashant Kumar, MD and CEO of Yes Bank, joining us on the show right now. Hi, very good morning and thank you so much for your time, sir. Firstly, we have seen the growth in your operating profits that remains strong this quarter on account of the lower cost to income ratio, and specifically the employee cost and other expenses were almost flat on a YY basis. Can you tell us if there was any one-off impact, what led to this phenomenon, and will cost to income fall even further going ahead?
No, so if you see like operating profit continuously improving, and this time also like 25%, and this is on account of NII, the non-interest income, and also a very tight control on the cost side. Okay? And we have also seen the improvement in the cost to income ratio, which has actually come down from almost 76% for the Q4 of last financial year to 67% for the current year. So I think we would continue to see this trajectory. There is no one-off. I think this is more in terms of a very focused attention in terms of cost and also in terms of increasing the income side.
Right. Mr. Kumar, so any target range for cost to income in the coming quarters that you have in mind?
So it would continue to be on a downward journey, and we would like to see maybe if it can happen in the early 60s by the end of the current financial year.
All right, but Mr. Kumar, when we see your loan book growth, on the other hand, that remained soft this quarter. For our viewers, can you tell us, was it a conscious call to slow down your loan growth in some of the segments? What are the key strategies to achieve that 12 to 15% growth rate?
So basically, the loan growth, if you see, is coming from four different segments. One is the large corporate, which is growing around 12%. The other segment is the mid-market, which is growing between 20 to 25 continuously. The third segment is the SME, which is also growing between 20 to 25%. I think the fourth segment, which is almost like 41% of our loan book, which is the retail one, there was a calibrated call to slow it down in the current financial year. But now, after taking all kind of measures in terms of strengthening the risk underwriting and also in improving the collection. And also there was a calibrated call to go only for those retail asset products which are profitable. So we are now quite confident that in the coming financial year, that is FY26, even the retail would be growing between 10 to 12%. So I think with the combination of these four different segments, the bank would be in a position to achieve a loan growth between 12 to 15%.
Right. Mr. Kumar, so do you see any risk to the asset quality of the bank, specifically from the retail or any other segments going ahead?
No, actually, the issue on the retail side started happening somewhere in the FY24 itself, and which was not only confined to us. I think that was across the banking industry. But I think the good news that now it has stabilized. And actually, if we see the Q4, the slippages have started coming down. So I think this is something like the retail slippages have come down by 40 basis points. And we are seeing a similar trend in the behavior during the current month also. So we are quite confident that whatever was the issue on the retail side for last 18 months has not only been contained, actually now it has started coming down.
But also, Mr. Kumar, talk to us about the deposit growth outlook, because the deposit growth rate was also soft for the bank versus the peers and also versus the banking system overall. Now, with rate cuts and improving liquidity, some banks are suggesting a strong deposit growth along with the improvement in the CASA in the coming quarters. Help us understand what could be in store for Yes Bank. What's the outlook?
I think the deposit growth which we are seeing, which is the published deposit growth of almost like 6.8%, this is more of a year-end phenomenon. If we see the average growth on the deposit side, we have actually achieved a 16% growth on the average deposits, where the current account was more than 20% and saving bank was more than 32%. So basically, this number is more in terms of a year-end phenomenon, because last year, I'm talking about FY24, the March we have seen a abnormal growth on the deposit side. But on the average, our deposit growth has been extremely good. And that's why we have been able to contain our cost of deposit. Despite so many headwinds, our deposit costs remain between 6 and 6.10%. And we continue to maintain a very healthy LCR of 125%.
Right, Mr. Kumar, also your NIMs have fairly remained stable in FY25 versus FY24. The cost of funds have also remained fairly at around 6.1%, although you did mention that the PSL related deposits will go down below 5%. Tell us what's the path going ahead when it comes to the cost of funds. How are you planning to manage this in order to improve your NIMs?
No, absolutely. I think on Friday, our Asset Liability Committee has met and a decision has been taken to reduce the rates on the saving bank and also on the peak fixed deposit. So I think we have taken those steps where the cost of deposit in the current financial year would come down. And as you have rightly mentioned, in terms of RIDF deposits are also coming down, and from 11% to 8.7%. And in next 2 years, it would come down to less than 5%. So any negative impact because of the lower yields on the RIDF would also actually help us in improving our NIMs.
But Mr. Kumar, I just wanted to once again put the light on the rate cut scenario that we are going through now with RBI cutting interest rates, and there are expectations of a further 50 basis points of rate cut. Tell us how sensitive is your loan book growth? Give us some understanding there, and also what portion of the loans are EBLR repo linked, and how are you planning to mitigate the NIMs compression?
No, I think this is exactly the issue which the entire industry is facing. Like for us, almost 60% of our loan book is on the variable rate, whether this is linked to the repo or the T-bill. Another, say, around 30% would be the fixed rate, and less than 10% would be on the MCLR. So whenever there is a rate cut from RBI, it has an impact in terms of yields on our advances. But that would be offset by reducing the cost of the deposit, which I think not only us, but so many other players have already taken a decision to reduce.
Right, Mr. Kumar, you also mentioned about the ROA target of 1% in the coming quarters. That's a 30 bips expansion from the current levels. Tell us what will be the key levers for ROA expansion for the bank.
So I have mentioned that we continue to stick to our guidance of 1% ROA for the FY27, but we are also confident that the current financial year, when we are exiting in the fourth quarter of the FY26, we would be targeting a 1% ROA. And this would be mainly coming from by improvement in the margins, which would be a function of the NII, non-interest income, and the control on the cost side, but also in terms of the credit cost, which we are seeing is continuously coming down, would also help us in terms of achieving our restricted goal of 1% ROA in next 2 financial year and exiting the current financial year in the fourth quarter with a 1% ROA.
All right, we let you go on that note, Mr. Kumar. Thank you so much for taking the time out and speaking with us and giving us a sense that from here on, where are the numbers headed when it comes to your return ratios as well as your NIMs.